What if I told you that America's first major financial disaster didn't happen during the Great Depression, or even during the famous crash of 1907, but in the early spring of 1792, when Wall Street was nothing more than a cluster of crowded streets, a handful of brokers, and a nation barely learning how money worked? Imagine a marketplace so young that most people didn't even understand what a stock was, and yet suddenly, it felt like everything was just skyrocketing in value every single day. The early United States was desperate for stability, confidence, and growth, and speculation became the new national fever. Brokers whispered of fortunes made overnight. Merchants spoke of investments doubling in weeks. And ordinary citizens wondered whether they too could ride this wave of opportunity. But beneath the promising glow of early prosperity lay something dangerous, a financial machine that was accelerating faster than anyone could control. As credit expanded, loans became easier to obtain as people started talking more and more. The buzz really picked up. The prices of government securities soared beyond their true value. At the center of this frenzy were two forces battling for economic influence: the U.S. Treasury under Alexander Hamilton and a rising group of private speculators led by wealthy financiers like William Duer. Their rivalry, ambitions, and strategies created the perfect storm, one that pushed the infant American financial system to the edge. As the debt from the Revolution was reorganized, trading volumes skyrocketed, and the promise of wealth spread like wildfire. It felt like the birth of a new financial empire. But behind the scenes, money was being borrowed recklessly. Promises were being made with no collateral, and loans were being taken out simply to pay off older loans. By February of 1792, the pressure in the system was already starting to crack, even though most people didn't know it yet. The streets of Wall Street were alive with optimism, but beneath the surface, fear and uncertainty were quietly tightening their grip. The crash itself began subtly, just a whisper, a rumor, a few brokers suddenly unable to pay their debts. But once the first domino fell, everything accelerated with terrifying speed. William Duer, the man many believed to be invincible, had borrowed staggering amounts of money to corner the market on government securities. His plan was simple: buy up as much as possible, artificially inflate prices, and then sell at a massive profit. But as the cost of credit increased and investors became suspicious, prices began to fall. Duer's empire, built entirely on borrowed money, crumbled nearly overnight. When he could no longer pay back his loans, panic spread like fire through the narrow streets of Manhattan. Every broker who had lent him money suddenly faced catastrophic losses. Some tried to sell their holdings to cover debts, but every sale pushed prices even lower. Crowds gathered outside coffee houses and taverns where early trading took place, demanding answers, demanding honesty, demanding money that no longer existed. Within days, the panic became a full-blown crisis. People shouted in fear, traders argued violently, and the young American government began to realize that its fragile economy was teetering on collapse. The early stock market, which just weeks earlier had seemed like a source of endless opportunity, had transformed into a battlefield of desperation. Some brokers locked themselves inside their offices, terrified of the chaos outside. Others fled the city entirely, and rumors spread that the entire financial system, still in its infancy, might not survive. The conflict grew darker. Families lost savings, merchants went bankrupt, and the credit system froze completely. Businesses that depended on daily loans suddenly found themselves unable to operate. Even those who had avoided speculation felt the fallout as confidence evaporated and lending halted across the young nation. For the first time, Americans realized the true danger of a financial panic. It wasn't just numbers on paper. It was fear, raw, uncontrollable, contagious fear that spread from person to person, affecting everyone from the wealthiest merchants to the humblest workers. Alexander Hamilton, watching from the Treasury, understood the stakes. If the panic continued, The United States might lose its credibility on the global stage before it even had the chance to establish itself. Something had to be done, and quickly. The comeback began with decisive, unprecedented action from Alexander Hamilton, who understood something that few others did at the time. Financial panics were not merely economic events, they were psychological ones. To stop the collapse, he needed to restore confidence. Hamilton authorized the Treasury to buy government securities aggressively, using public funds to stabilize prices and signal strength. He also worked with major banks in New York and Philadelphia to increase available credit, making loans easier to obtain so traders and merchants could continue operating. This move, radical for its time, reassured the public that the government would not allow the financial system to fail. Slowly, the panic began to cool. Prices stabilized. Brokers are back at their trading houses. Finally, businesses are back in action, and the fear that had gripped the city began to loosen its hold. The redemption of the markets was not immediate, but it was powerful. Within weeks, the most dangerous part of the crisis had passed. Hamilton's big move kicked off financial regulation in the U.S., changing everything for good. It proved that a coordinated response to market instability could prevent a young economy from collapsing. Perhaps more importantly, it established a precedent. The government would step in when the financial system was at risk. For Wall Street, the Panic of 1792 became a defining moment. It taught early traders that unchecked speculation could destroy fortunes in hours. It taught the nation that confidence, not just capital, was essential to a stable economy. And it shaped the strategies and systems that would guide American finance for centuries to come. The payoff, though unexpected, was profound. From the ashes of this first crash rose a stronger, more disciplined financial market. The panic revealed the vulnerabilities of speculation, but also demonstrated the power of decisive leadership. And for Wall Street, whose future still hung in the balance, the crisis became proof that even in moments of chaos, risk could be tamed and order could be restored. As the city recovered, new rules, partnerships, and trading practices emerged, slowly forming the foundation of the modern New York Stock Exchange. The Panic of 1792 wasn't just the first crash, it totally shook things up. Can you believe it? It was the very first lesson, and it was unforgettable. A warning, a turning point, and a reminder that the history of money has always walked the line between ambition and danger. And above all, it showed that even in the earliest days of Wall Street, resilience was already part of its DNA.